I'm so sorry. I'm not so sure if I understand the concept of inheritance tax because it's not something that is available in Hong Kong. Can you explain a little bit?
Well, we have a tax in the UK that broadly applies on death, which is obviously a subject that I know culturally it's not a subject people probably talk about all the time. But as from a UK perspective, we recognise the idea that in the event of somebody's death, tax will be applied at a rate of 40% on the value of their assets over a certain amount of money. Now, that certain amount of money is typically the first £325,000 worth of their estate, which is subject to tax at 0%, and the balance is subject to inheritance tax at 40%. So people typically take steps to try and mitigate their inheritance tax liability that might arise on death through making lifetime gifts. Now, if you make a lifetime gift and survive 7 years, the value of that gift is outside of your estate, and that's good. If you are somebody who, and the other, sorry, just to pause there actually and draw out a distinction. If you're UK domiciled, you're subject to inheritance tax on your worldwide assets. So wherever they are, in the event of your death, you will be subject to inheritance tax. If you're non-UK domiciled, you'll only be subject to UK inheritance tax on the assets that you own in the UK. So people will either choose to own their assets and think about mitigating inheritance tax, or they might think about taking steps to reduce their inheritance tax exposure by perhaps structuring gifts outside the UK. So say, for argument's sake, in our example, mum and dad wanted to make a gift to daughter's UK resident. So rather than them giving the money to her in the UK, which might come into a UK bank account, and then saying, this money's for you, that's a gift of UK property, which would then be subject to the inheritance tax rules, and mum and dad would have to survive 7 years. If they structure the gift so that they make the gift outside the UK, that's outside the UK inheritance tax net. So any money that then daughter brings into the UK after the gift is made isn't subject to inheritance tax if mum and dad happen to die within 7 years. So it's navigating these rules, and also worth drawing out, although not particularly relevant for this example, but relevant for anybody who's looking to come to the UK and stay here for more than 15 years, is that you can say that you are non-domiciled here, which is great in terms of your assets that are in the UK will be subject to inheritance tax, but anything else outside the UK won't. But when you've reached 15 years of tax residence, in year 16, you are deemed domiciled here for tax purposes, which broadly means that you will be treated as if you are domiciled in the UK, and therefore all of your worldwide assets could potentially be subject to inheritance tax. Anybody in that situation or facing the end of their 15-year term would be as well to think about what their intentions are for the future. If they're intending to stay in the UK, it may be appropriate for them to set up a structure like a trust to shelter those assets outside the UK in a trust to ensure that they're not part of their estate for inheritance tax purposes. So there's another layer of planning that can be done in the future. So far, we've been looking at people's immediate needs and the idea of coming to the UK. Those needs will evolve in due course. People will probably find that 1 year spreads into 5 years, 5 years into 10, and 10 into 15, and suddenly they spent a significant amount of time in the UK, and the opportunities to plan will reduce accordingly the longer they spend here.